All right, we're going to give everybody a couple of minutes to log on or register in here. If you have any questions that you're just itching to ask, make sure that you put them in the Q&A section, and we'll try, or the chat section, and we'll try to get to that. But we should have a couple folks falling into the queue here soon. We'll let you in. So, all right, there you go. Yep, cool.
All right.
All right, everybody's falling in. It's a lot more interesting quarter, guys. I think that there's a couple more things, a couple more questions going on, a little bit more volatility, making everybody talk a little bit. So, or at least interested in what we got going on. So,
yeah. I think most of our attendees are probably on now.
Everybody's in?
Yeah,
All right, great. Well, we'll get started. Hey, welcome everybody to the third quarter edition of the Stein Wealth Advisor Quarterly Economic Update. We appreciate everybody joining us live that have questions. We can see everybody there, so welcome. If you do have questions, you're always welcome to drop them in the chat or the Q&A, and we'll try to get to those. But we have a lot to cover today. One thing we wanted to do before we get started is talk a little bit about why we do these quarterly updates, just to let everybody know. One, we want to help filter the news, right? So there's a lot of news going on. There's a lot of economic news, especially these days, and we want to help filter that out for you guys, make sure that you're getting pertinent and accurate news and topical stuff with that. Second, we want to bring you our best ideas to let you know what we have going on here at the firm and what we're doing to protect, more importantly, and grow your assets. So with that being said, guys, there was a lot going on this quarter. So Josh, what were some of the big things going on this quarter that you took notice of that you think we should all know about?
Hello, everybody. Appreciate it. Like Joe said, appreciate you all tuning in. I think the big news this quarter is that really scary word that everybody's been throwing around on the media. Actually, it's scary, but inflation. And that's really the new animal that's come up and kind of reared its ugly head. And, you know, if this is no surprise, if you've been on our webinars since the beginning of COVID, like literally like in January, February, probably of 2020, we started discussing potential inflation then. And now, you know, you can't go a minute without listening to the news and hearing about inflation. And really, we're coming off this economic period that most of us have been in for 20-ish years in a relatively stagnant to no inflationary environment to now where it's like, oh my gosh, things are costing more. And what does that mean? We've had a lot of content about inflation previously, and most of our sentiment hasn't changed. Although I think people are starting to now really conceptually understand the short-term, at least, impact of just things cost more. But what does that mean for the stock market? We can talk a little bit about that. What are our thoughts with regards to what that's going to look like long-term? We talk a little bit more about that, but I think from my perspective, that's probably the number one newsworthy item that I've been paying attention to.
Absolutely, cool. Mel, anything that you're seeing that's jumping out at you with like what you're hearing from folks or what you're reading from the economics and all that?
Well, I mean, obviously, I think with the volatility picking up in the last couple of weeks, you know, we're hearing a lot more from clients. And also, I mean, people tend to perk up when they hear this stuff. I mean, I think we do want to put some things into perspective today. Yes, I think there's been some volatility over the last few weeks, and we've seen sort of the S&P and some of the other indexes taking some steps back. But that doesn't mean over the long run, and even this year, that those indexes aren't up significantly. I mean, we've actually been expecting this for some time. I mean, first of all, October is a traditionally very volatile month in the stock market. Number one. Number two, with COVID numbers increasing and continued disruption in the supply chain and these inflationary pressures and some of the uncertainty around here. I mean, and just the fact that we were, I don't like to say overdue because it implies that, you know, just because the stock market goes up that it's going to come down, but we've been way out of like correction territory for a long time. So, you know, things have just, you know, gone up and continue to climb. And I think people continue to have those expectations. But I mean, we're not really surprised by some of this volatility picking up, given, you know, what's been happening around the world and sort of COVID recovery being stunted, supply chain stuff happening, which we're going to talk a little bit more about the long-term impacts of that. And so we've continued to be conservative and manage risk in our portfolios and not just focus on the upside, because that's what tends to happen in these situations. I mean, when you look at like S&P 500 returns or other indexes over the past 10, 5, 1 year periods, I mean, you see these returns, and sometimes it's easy as investors to forget about the fact that we still have to manage the risk in our portfolios, and that's just as important as managing the return. Because at the end of the day, it's about how much money we're making, not about the percentage return we got. Because oftentimes, if you're managing the downside volatility, you don't need nearly as much upside volatility to make the same amount of money. And so we're always looking to, and sometimes, I mean, we're always looking to smooth that out. But also, in addition to that, I mean, sometimes we're fighting like an uphill battle when things just keep going up. Nobody really wants to talk about managing risk, but we know that that is often the most risky time for a portfolio, and when we need to be making risk mitigating decisions, which is what has been the topic of our investment committee meetings for the last 2 weeks here.
Yeah, I mean, the interesting thing is most of what has transpired this year has been actually relatively predictable. Like I mentioned, and originally we've been talking about a lot of this stuff for quarter upon quarter upon quarter. The only thing that hasn't been predictable is essentially when things would happen. So when would inflation become an issue?
Well, and I do think it's important to note, we actually haven't just been talking about it. We've been implementing changes in the portfolio since this time last year to mitigate these risks. So those are things that are happening across the board already.
Yeah, I mean, you take a situation where you turn off the economy. We can talk a little bit about what that means too, but and at the same time, basically inject it with more money than we've ever seen in terms of the velocity of the money supply increase ever in the history of the United States, and break the supply chain at the same time. So you've increased demand significantly and you've reduced supply, and essentially that is classic textbook inflation.
Well, and talk a little bit about the supply chain shortages that are happening, because I know it's like we hear from people, and I know we all complain about it. My Amazon deliveries are late. I'm not getting, I can't get the supply of like at the Halloween store. They only have like a certain number of things. You can't legitimately get things. And I think everyone's thinking, well, the supply chain should be fixed by now, right? Like everyone's figured out how to manage through COVID. But that's not necessarily true. I mean, there's been permanent damage.
Oh, it's very much not true. The economy isn't a light switch. We always talked about turning on the economy when it was turned off. And for all intents and purposes, the economy was turned back on, but it's not a light switch. You can't just turn something on. And when we quote unquote turn the economy back on, it was the supply chain was different at that point. I mean, businesses had gone out, people had lost their jobs, and those businesses didn't come back and may never come back, not to mention.
Well, the employment situation has changed too. I mean, you hear all over the place, people can't find anyone to work, and there's a million reasons for that too.
I mean, the supply chain is a living, breathing animal that has relied on symbiotic relationships over decades and decades and decades to really create what it is today. We were talking the other day, and we used the simple analogy of a pencil. And by nature, a pencil is a very simple object. It's a little bit of wood, some graphite, and it's a little bit of rubber, and whatever it is. But think about what really has to happen to make that pencil, all the way from the original tree getting cut down and logged and cut up and then shipped somewhere else to be cut up even more, and taking out the graphite and the rubber and putting it together and then getting it to the shelf at Walmart and then having it be sold and checked out by somebody. It's a very involved process just to get your pencil. Take one or two of those components out, and all of a sudden you don't have any pencils on the shelf. You're like, it's just a pencil. What's the problem? Well, that's the problem. Not to mention everybody has way more money than they've ever had before due to the stimulus that we've received. And so everybody's out there buying pencils. And obviously pencils aren't probably the first thing that people are buying, but you get the point.
We can see the shortages with microchips, right? So now if you've tried to buy a new car recently, you've noticed a little bit of a price increase as well as a delay in getting that brand new vehicle that you're waiting for. And we've seen that in the used car market along with a lot of other markets. But these supply chain hiccups have been very unique. And we were even reading that a lot of our big box retailers are having to go out and get private shipments to get their product here. And they're having to contract private vessels outside of the normal shipping, things. So we do have a lot of unique supply chain issues, but it's also, I think, speaking back to the interest rate situation, you have a low interest rate environment. A lot of folks are being incentivized to build new houses, buy bigger houses, and this is creating just a unique situation in the US economy right now. So
It's the perfect storm.
it's a perfect.
Well, it really is. I mean, when you're buying houses, doing things like that, you're also increasing demand for stuff too. I mean, I guess what everybody probably wants to know is, well, what do we do about it?
Yeah.
There isn't a silver bullet for combating inflation or a lot of these things that we're talking about in portfolios, but we are reviewing, where our money is invested. I mean, number one is we've continued to safeguard the bond portion of portfolios, especially for those clients who are distributing and needing income from their portfolios. 40 or 50 or 60% of the portfolio could be in fixed income. So I know we always talk about the stock market, but the bond market is a really important component of many of our portfolios, and they're probably most at risk to high inflation, higher interest rate environments, which is what we may be, entering into. So we've continued to safeguard those portions of the portfolio. And on the stock side, rotating, where we own and what we own in order to take advantage of some of the areas that either A, have opportunities to rebound, so sort of a buy low, sell high situation. Some examples of that were like some small mid-cap investments we did earlier in the year, looking at like emerging market countries and just looking at over the next 20 or 30 years, where is there going to be population growth and where's the growth in demand coming from, and then what sectors are going to continue to be at the forefront of growth in portfolios. And then even in the near-term future, what areas, AKA things more like value stocks, like retailers, some of the travel, industry, these things that haven't fully recovered yet from COVID, where are the opportunities there? So we've been sort of massaging the equity portion of the portfolio as well, but most importantly, staying within and continuing to mitigate the risk in the portfolios, because we do anticipate probably some choppy waters.
Absolutely.
Yeah, and just to put into context also, and I always try to remind people of this, that inflation doesn't directly correlate with negative stock market returns. It's not that simple. And in fact, there have been many periods where we've seen rising inflation with double-digit stock market returns. There have been periods where that hasn't been the case, but they're not directly correlated, which is why even though we've been talking about inflation internally for quite some time, we've still had a reasonable exposure to equities, because it's not so simple to say, okay, we expect inflation, let's sell our equities. In fact, long-term equities have been a considerable hedge against inflation. And when we consider the interest rate environment we're in right now, it even looks even more appealing, because with fixed income or cash or bonds or anything of that nature, we're probably actually in a worse situation than we were back in the 80s, when I think we really had the last kind of higher inflationary period, because at that time interest rates were higher. So your net return after inflation was likely higher than it will be today, with basically zero return on cash, and let's call it almost zero return on bonds, without stretching to high yield, which is a polite way of saying junk bonds, where you're essentially then correlating with stocks. So,
and increasing the risk in your portfolio,
significantly,
which is what we don't want to do.
and if you're going to correlate with stocks, then you might as well own the stocks. And when I say correlate, what I mean is those are two asset classes or two securities that move in tandem. So if stocks go up, you would expect the other asset class to go up, and vice versa. And that's a risk, because you don't want everything to correlate. You want some hedging to ensure that if we do see stock market volatility per se, that you have something that's going to help buffer a little bit of that risk.
Kind of like a ballast. Yeah,
Mhm.
that's a good way to put it.
Well, at the same time, though, we've been also moving more towards dividend bearing, other type of asset classes that behave like bonds, but are going to have higher income potential than the bonds, because we can't just have 40 or 50% of our portfolios hanging out in a dead asset class. I mean, those clients need, income. We need to continue to grow the portfolio and manage the risk. So it's really just striking a balance between those. All of this sounds really scary. I do have to say though, like my new mantra is the market is like predictably unpredictable. I mean, this is not stuff that we can't continue to manage for all of our clients. And I think that's the important thing, is trying to really not focus on short-term results. And I know everyone says that, but like stretching out, like looking at the performance over time, looking at how you're meeting your goals, because the reality is in short-term periods, the market can be very unpredictable and not make a whole lot of sense. But in longer-term periods, a year, 2 years, 5 years, 10 years, they're very predictable. They make a lot of sense. You can manage these returns and this risk through using really sophisticated methods that are, a lot of them are related to just statistics in general. I mean, within a very high probability of success, we can, we're very, I don't want to say success, within a very high probability, we know like pretty much how portfolios are going to behave. It's just a matter of stretching that out and being able to take a step back and not make mistakes that are emotional when this stuff is happening. So I don't really know in the short term where this is going to go. I mean, a lot of people are bullish on stocks. I'm starting to get emails from clients though about the doomsday type of economic predictions again, which means that those people are starting to, talk louder again. Although, I mean, we get those all the time. We've been getting them for the last 20 years.
There's a
So
lot of people that make a living off of making bad predictions and portraying.
nobody really knows though. There's a lot of economists who have really positive predictions. There's a lot of them that have really negative predictions. We really
I think
don't
what you said,
know.
Melissa, expect the unpredictable nature of the market, right? Expect the unexpected, because the reality is we have predicted that with our probability metrics and how we mitigate risk, because the risk metrics are as important as the returns we are seeing.
The short-term events don't matter as much as you think they do. I guess that's where we're
Let's
getting.
talk about that for a minute, because you bring up a very interesting concept of predictably unpredictable. I'd almost venture to say that with a lot of the very unique circumstances we're seeing right now, the stock market is probably the most predictable. Supply chain shortages, that was hard to see. That took a global pandemic to really throw that monkey wrench into that system. Politics, highly unpredictable. We really have no idea what is going to happen through politics.
Well, the government.
There's a lot
Influence.
of other countries that have very unique geopolitical situations right now. So we're at a very transitional phase geopolitically around the globe right now.
Sure.
And to talk briefly about China, they're showing their next hand. And I mean, we are not going to see them slow their growth, but economists are predicting a slower growth because of their, focusing on, getting rid of private schools, as well as some of these television stations. So we'll see how the world responds to that trade. But I do think that we're making headway in regards to that, because you do see embargoes, trade picking back up across these country lines as we get out of the pandemic. But there were pandemic, reasons why countries weren't trading as much, but we're getting out of that.
I mean, to Josh's point, I mean, these things are unpredictable here. You get to talk about a country like China. I mean, we could have a whole nother, economic
Sure.
update just on China. But as far as you were saying, with the stock market being.
Well, yeah, I mean, those are probably what I was mentioning before, the areas of more, when I use the word concern, I mean, less able to be controlled and less able to be balanced. Stock market risk can be relatively balanced for all intents and purposes, but we can't balance government policy, because that can change. We can't balance political forces and how those impact the stock market. But at the end of the day, we can reasonably manage volatility. And so that always kind of makes me feel a little bit better. When we back tested our probability models based on what happened during COVID, I was really pleased to see that despite markets going down, just admittedly despite our portfolios going down, which I think everybody would understand, although not for long, they all were within the expected probability range that we assigned to portfolios. And that made me feel good, because at least when we look into the future to essentially one of what could be one of the most unforeseen impact on the markets maybe in our lifetimes. I mean, will something be more impactful to the stock markets than this past global pandemic in the next 20, 30 plus years?
Right.
It's hard to say, but maybe not. Our models held, at least our probability analysis held, saying if we do A, B, and C within your portfolio, within a 95% probability, you should expect an upside and downside range of this. And that held. So talk about predictability. I mean, in one of the most unpredictable economic events ever, our predictability models held.
Oh, that's
Right.
important.
And this is also the case for not making huge bets in portfolios either. It doesn't work consistently over the long term. I mean, yes, I would love to say that we could always cherry pick the best asset class for the last 10 years or 15 years. But there's a couple issues with that. Number one is half the time you're right, half the time you're wrong. And the cost of those could be different magnitudes depending on how wrong you are and when you're wrong and what that particular situation is. Number one. And number two, that's even if you invested in the best performing asset class for the last 10 years, if you actually do the math, because of like the increase in risk, in other words, what Josh is saying, like the bands of up and down, you might actually end up at the same place. And if you would have managed money much more conservatively, you could have even ended up worse. So higher return doesn't equal more money. I know that sounds counterintuitive.
Timing becomes a play, a lot of that plays.
Well, we use the example a lot where we back tested S&P performance from around the time before the tech bubble through the global recession and in 2008. And had you invested in the S&P 500, you still certainly would have made a lot of money. Very good return, even with those downfalls. But had you taken half the risk and only received half the return, guess what? You actually would have ended up with more money.
Now, a little bit, or about the same, really.
It's still more though, but
Right.
for all intents and purposes, it's half the risk.
Yeah.
Now that's one unique period, and we could show a million other periods that maybe didn't look like that. But at the end of the day, if you were to have a choice between half the risk and potentially the same, if not more return, would that be of interest? I think most people say, well, of course.
Sure.
So, that's kind of the give and take when it comes to diversifying is when you own a lot of things, you're never going to own the single one that does the best because you own a lot, but you're also never going to only own the one that does the worst. And that's really the key to diversification.
Cool.
I'm
So,
going to stop for 1 second. I just want to see if there's any questions.
yeah, let's
I know
start with
one's
questions real quick.
if you have a question, just move your cursor down to the bottom and you can either, I think you can raise your hand, you can chat.
Yeah,
If
I think we
there's
got
a
to do the
Q&A,
chat.
I don't see anything here.
Click on the chat, but
We'll keep talking for a couple more minutes,
so-
although we're 25 minutes in, guys. We're supposed to keep these
I
brief,
know.
right?
So there were a couple of things I wanted to ask you guys before we wrap. So first, we did, and I think it's great, and economic opinions are like something I can't remember, but everybody has them, and we really like to filter this out for you. But I want to know two things before we break. One, what are the big things that you want clients to focus on before year end? Some more like tactical planning kind of stuff, Mel. And then I want to know before we wrap, what are you guys excited about coming up with the economy or next year? What are you excited about? So tell me, first things first, let's get to business. What are the things clients need to be worried about year end tactically, year end stuff? What's on your guys' mind for folks?
I mean, it's mostly the same stuff every year, but it's always good to be reminding people. Some of the stuff we just do behind the scenes without people thinking about it. Number one is RMDs, required minimum distributions.
For you, your parents, your grandparents, if they're over 72, because we didn't have it last year, right?
Right, or for some people who are already taking them, you could be.
71.
Yeah, can you still be? Or are we past that?
Maybe.
Either way, I mean, if you need to take an RMD. The reality is after 70 and a half, it used to be, but now it's 72, and that went into effect. Was that in effect in 20? I'm sorry.
It was the
Remind me.
beginning of 2020, but then there were no RMD requirements. So
It was kind of an odd
It was an odd
situation.
year.
There was a change to the rule at that same time. And basically, no matter what, if you're 72 or older, you have to be taking RMDs from your IRAs. Where that becomes most important for our clients is if you have outside money that's not held at Stein Wealth Advisors, which I don't know why you would, no teasing, but this can become a problem. Here internally, we know that all of our clients meet their RMDs. If they do have outside assets we know about, we even track those to make sure that you're making those distributions before year end. Basically, what an RMD is the IRS says after you have money in a pre-tax vehicle like a 401k or a traditional IRA, after age 72, you're required to take out a certain percentage. This is really important because the penalties are really steep. We do a lot of internal audits here on that. But if you want me to bring up some other comments that actually have to do with that, because now you're going to open up a can of worms here. If you do have outside assets, you should let us know. B, we are going to make sure that they're going to happen. So if you haven't received your RMD this year, then you'll hear from our staff and make sure that it is happening. And C, if you do have outside assets and you want us to help you make sure that that happens properly every year and it gets aggregated, we also do that as part of our service. But lastly, you should also know that you can use your RMDs to make what we call QCDs, which are qualified charitable distributions. This is super important for those of you who are standard deductors, and many of our retirees are, because it's pretty much the only way you'll be able to actually make a charitable contribution without reporting it as income.
And getting a tax.
And you can't get a deduction for it anymore if you're not itemizing. I don't want to get into a lot of details about this, but let's say, for example, you have a $60,000 a year RMD and you're giving $5,000 a year to your church, but we don't know about that. Ideally, what you should be doing is sending that directly to the church from your IRA to make the qualified charitable distribution, so it gets excluded from income. If that's somebody on our call, feel free to, or anybody at all, just give us a call and we'll work through the mechanics of it with you. It's not really complicated, but we need to have a discussion about it.
Yeah.
So that's something I'm thinking about. 2 is we'll also be looking at capital gains distributions over the next month and tax loss harvesting, which means for those of you who have accounts that are non-qualified outside of retirement plans, joint, individual, custodial accounts, we're going to look at, is there anything we can do in the portfolios to make them more tax efficient before year end? We're automatically going to do that. But this also applies to any other positions that you might have outside of Stein Wealth Advisors as well. But we do like you to know that we're proactively looking in our managed portfolios that are outside of retirement assets to make sure that we're reducing taxes. 3, you should make sure that if you want to fully fund any like 401ks, 403bs, that all has to be done by 12/31. So let's say like you started a new job, you were halfway through the year, you didn't make any 401k contributions because you weren't eligible for the first 6 months. You started putting in 10% of your salary, but it doesn't get you up to the 19,500 limit that you can put in, or the 26,000, contribution limit if you're over 50. You need to adjust that now to make sure that you either A, make a pre-tax contribution to your 401k and get that fully funded, or
you can.
There you go. Thanks. I was just thinking about something else too. And something I'd like to point out, and maybe this isn't a year-end thing, but a lot of people don't realize they have access to a Roth 401k, which is basically the same plan that you have at work, but there's like a different type of bucket you can put the money into. You don't get a tax deduction for it now, but it basically puts it in a tax-free position forever. So that's something to kind of keep your eyes out for. So there's certain vehicles you have to put money into by the end of the year. 401ks, 403bs, I believe 457 plans. What are there any other ones I'm missing?
By the end of the year?
Yeah, I know SEPs, Simples, like small business plans, those usually have different deadlines.
Simples are over, you would have had to establish it already.
Right, by your tax filing deadline. So that
Just
would have been
double check that
October
all your
15th.
contributions are in that you're looking for, and you might have a better idea with your tax situation. So those are good. Were any more like pointers for the quarter?
Yeah, one last thing, Roth conversion strategies
Bingo.
also have to be done before the end of the year. So if you have money that you don't need and you want to convert it to a permanently tax-free position, maybe it's for legacy planning to leave with your kids, you don't want to pay taxes on it. Maybe it's just because you have some extra cash and you want to get some more tax-free money.
Take advantage of the Tax Cuts Job Act.
Yeah, I mean, taxes aren't going anywhere but up here. So, I guess I don't know that. I shouldn't say it so definitively.
No, I think that's all of our opinion. I think Tax Cuts Job Act goes away in 2025. So you're getting a 2% discount on any conversions you do between now and then, if you're already thinking about it. So
we do a lot of what we call like topping off our income tax bracket. So if the client has $100,000 left to go in their bracket and they have a bunch of IRA money, we'll convert up to some limit there to make sure we don't go into the next bracket, but still be able to get that money into a tax-free position. So those are just some of the things that we're thinking about. Not everybody realizes that we do all that stuff.
thank you.
I think that's
What are you guys excited about for 2022? We've had a crazy 2020. We've had a pretty interesting 2021. What are you excited about with the economy moving forward and opening back up? And
Am I supposed to get excited about the economy?
I don't know. I mean, we all get excited
I'm
about
teasing,
stuff,
of course
but we live in this world every day. I think that what we're optimistic about is important. So, like, what are you guys optimistic about moving forward?
Want me to start?
I mean, you can start. I have a few things to say, but
Well, we spend a lot of time focusing on the stock market, the bond market, those types of things. And I feel, and hopefully you all agree, that we do give a lot of education and guidance on those things. I'm excited about starting to expand that a bit. And in particular, Joe and myself have been working on some education curriculum about what we would call like alternative asset classes, cryptocurrencies, precious metals, private equities. Not because we necessarily utilize those in our client portfolios, but the opportunity to utilize those is only increasing, and B, people are more and more interested in it just because of the wider availability. So we've been starting to create a curriculum for not only education, but potential investment opportunities over time. So that's something I'm excited about. It's something that we've been talking about for a long time, and I think starting to integrate some of the education and potential investment in those things in the future is something that I look forward to.
Well, and for different kinds of investors, we are working on like enhancing some of our strategies with potential satellite strategies and things like that that are related to what Josh was talking about. So I would say I'm also excited about that.
Cool.
One of the things I am excited about, I think this is maybe not for the next year, but first of all, I'm excited that COVID numbers are coming down again. I mean, I know we have these like weird waves, but it looks like maybe the trend's coming back down. And I'm actually excited to see maybe us getting a little bit more back to normal next year. I mean, we'll see. I mean, the vaccination rates should go up. That's another thing I'm excited about. They look like they might be approving vaccines for ages 5 to 12, which is huge because regardless of what other people are doing, I mean, those children are now going to be eligible for that. And I think that could I personally think it's good for, to have those choices, but then B, and for everybody health-wise, but B, that could be the key to the economy getting back on track and us reaching more of what they call like this sort of herd immunity where COVID can't rear its ugly head as much. I mean, who knows what's going to happen with the science. But I think that's encouraging. But B, what I'm most excited about over the next decade is to see how this challenge across the world is going to fundamentally change the way that companies do business. Just like what you're talking about, Joe, with what you like these Walmart and some of these other big retailers, like basically getting their own cargo ships and like trying to figure this out. Like that doesn't seem like a big deal. But everyone is having to adjust and change, whether it be like those retailers are doing that or the way that people are employed and the flexibility the employers are given. And I mean, the whole face of how we do business, I think is going to change because of this. It's partly because of COVID, but it's partly because of the technology that has now been like accelerated. And the adoption rates of that technology are still really low. So like, I get excited thinking about, I know this seems like a little scary, but like if I was just like going to park some money somewhere for a long time and think about, well, where's all the growth going to be in the near future? I mean, US is always a great investment, but what about these emerging market countries that have very little adoption rates of technology? It's where all the population growth is. I mean, you look at countries like India, I think they have like 2% of people in India own washers and dryers. Like think about all the opportunity there is there. So I'm really excited to see that. I know it's a long answer and maybe not a full answer, but I think that there's going to be a lot of changes. A lot of them will be for the good, even way, after COVID is behind us. I mean, God willing, it is behind us or whatever. I mean, it really needs to get behind us, but that's what I'm most excited about.
What about you, Joe?
I'm always pretty excited.
That's true, you are big.
Well, and I'm very excitable, but I do think that to your points, we're going to see a lot of innovation regarding artificial intelligence and blockchain technology, which we're going to be doing. We did a CLE for our bar association. We're going to represent that to the clients on cryptocurrencies and all that. So the adoption of those technologies, although a little Skynet and scary and all that, it is going to change the way and the things that we can do. So I'm excited to see that. I'm also excited to see we're changing the way that we look at companies. I don't know if anybody's familiar with ESG investing, but it's a way that companies are starting to look at their sustainability indexes as well as the impact that they have on the workforces and the communities that they work in. And I think that's pretty cool. We're reinventing our economy. And I mean, I'm a kind of a history nerd, as a lot of you guys know. And when you look at pandemics, although they're terrible for cultures, for a lot of stuff, the growth that comes out of pandemics, and this is the first kind of global pandemic we've experienced all in the technological revolution. So although we saw how delicate our supply chains and our economies are, we also see how quickly they respond
And how resilient.
Bingo. So that gives me a lot of optimism. And I think that, what we did also see, guys, we saw a 50% uptick in people retiring. So we've had a lot more people coming through our doors that are retiring. We know a lot of the folks that are watching this are our clients. If you guys know folks that are in this huge wave of people exiting the workforce, please let us help them, because it is confusing. There's a lot of press out there. There's a lot of confusing stuff. We are trying to bring awesome content and reasonable content. We just want to give you the facts and tell you what's up. But I think that that was pretty good. I mean, is there anything else that we're missing? I think that was the main.
I think we
main things we
covered what
wanted
we
to
need
cover.
to cover. Even,
Any final
you guys have any
questions before
questions?
we-
Yeah, we didn't get any questions. If we have a couple of questions.
Well, that means we just did a perfect job then.
Oh, making it easy on us.
I know.
No, the questions are coming. Just stay tuned, I'm sure.
I
So
will
if you
give a
guys
like
have
on
any
it.
questions, we'll leave it open. But other than that, we appreciate everybody's time for those in our live Zoom studio audience and our folks watching afterwards. So.
Couple things. If you like the format of this, let us know if it's good information. If there's something you have a suggestion for, we highly appreciate it. I mean, we do this for you. As much as we like to hear ourselves talk, we want to cover. Yes, it looks really good.
Thank you.
There's we want the content to be relevant to you guys, not just us sitting here talking to each other. I mean,
Right.
we talk to each other all day, and these are the things that we discuss. But let us know if you have any suggestions for anything. We're always here for you. Pick up the phone. Don't sit around worrying about things, wondering.
That's our job. Let us do that.
But we
for you.
do have your back, and we are always proactively managing these portfolios and taking these things into consideration. So that's the important thing to know as well.
All right.
I think we should sign off now. What do you think? No questions.
All
All
right.
right, guys.
give an
Hey,
A+,
thank you all for
Jonathan.
joining us.
Thanks,
And,
everybody. It's
thank
good
you.
to see
We're
you.
here for you. See you
Have a
soon.
fun and spooky Halloween. All right.
We'll be
Bye.
back with costumes.
Bye.
See you guys.